Welcome everybody again to the 4Q25 Commercial Real Estate Fear and Greed Survey Results webinar. My name is Alex Thomas, Research Manager on the macro team at John Burns Research and Consulting, or JBREC for short. I'm joined today by my colleague Chris Nebenzahl, who's VP of Rental Research, also at JBREC. Today we got a nice short webinar for you guys. We want to go through the highlights for our most recent Fear and Greed Survey results. We just launched yesterday the results, so we're going to walk through the high level there. I'm going to talk through that for about 15-20 minutes, and I've also got my colleague Chris Nebenzahl here, who's going to do a deeper dive on specifically the multifamily space right now. There's a lot of interesting things going on there. So let's go ahead and get into it. Also, our contact information is all down there, so feel free to reach out to us as well with any questions after this. Before we get into it, just a little bit about JBREC, or John Burns Research and Consulting. We really look at the real estate industry from every angle. So here's a nice pie chart of all of our different clients that we have. We've got a really diverse client base. We work with home builders, rental developers, lenders, securities investors, building products manufacturers, distributors, private equity, land developers. We really run the whole gamut on the real estate side. So we take pride in knowing that we cater to a diverse range of clients. The way that we think about research is a little bit different too. We've got this kind of top-down approach that we pride ourselves on. We care a lot about the big drivers of change across real estate, whether that's technology, whether that's policy. We really look at this kind of top-down approach. So we've got our macro team, we've got a demographics team as well that looks at kind of the long-term trends and the impacts on real estate. That's the top-down side. We've also got this bottoms-up approach as well. So we've got the research side of our business. We've also got our great consulting team. We've got consultants spread all across the country in different markets across the country. They're really our boots on the ground team. We get a lot of great local insight from our consulting team. They're out there doing feasibility work, site studies, market rankings for all of our clients across the country. That really helps inform our view from the ground up. In addition, we've got on the research side a ton of proprietary data. We do a lot of work vetting out data providers and ruthlessly cutting any data that we don't believe in. So we really are very confident in the data that we do have. We also put a lot of emphasis on custom data as well, including monthly surveys. We run something close to about 20 surveys now, both business to business and business to consumer as well. The reason that we do that is we find that the survey data, the sentiment data, tends to lead a lot of the hard data that's out there. So we take a lot of pride and put a lot of weight on the expectations component of our surveys as well. And then in addition, our clients are also part of what I call the JBREC extended universe. We've got our data reports, of course, we've got our dashboards, we've got our data tools, but you also get access to client conferences, special reports, white papers, as well as access to our whole team too. You know, our contact information was at the front here. We really want to make sure that our clients reach out to us. We learn a lot from our clients, just as we hope they learn a lot from us as well. I won't go through all this, but just some highlights here. We run a ton of different surveys, including our Fear and Greed survey here. We survey consumers regularly as well. We pay attention to everything going on with all the publicly traded companies across housing, multifamily, commercial real estate, building products, et cetera as well. We've got our quality control database. We do a lot of the data analysis ourselves, though. We don't just emphasize the data, we also emphasize the findings. We want to be kind of the outsourced research department for a lot of our clients. We want to do the hard work and the heavy lifting for you and focus on those actionable insights. And then again, we've got a ton of different great conferences and webinars that we do. Getting into the results here, we just released our fourth quarter 2025 Fear and Greed survey. This is our survey that we do in partnership with CRE Daily, sponsored by InvestNext, of commercial real estate investors all across the country. So a little bit about the survey here. We really created the survey. You know, there's a lot of data across the commercial space, but most of it is kind of that harder lagging indicator, right? That hard data. Really, what we put a lot of emphasis on, the gap that we were trying to fill, is getting a sense of investor sentiment, getting a sense of expectations. So that's really what we try and focus on. Every quarter, we get somewhere between 500 and 1,000 market rankings from investors across the country. Our most recent survey ran between November and the first day of December here. So important things to note there. That's before we got the most recent set of jobs data and also before the most recent Federal Reserve rate cut. So just something to note there as you're interpreting the results. We focus on 4 main commercial real estate sectors: multifamily, industrial, retail, and office. Everything's nicely color-coded, so you can pay attention to the color for the sectors that you care most about as we go through the results here. And we have a really diverse sample size as well. We survey owners, operators, GPs, LPs, brokers, and some that don't fit neatly into any of those categories. So a really great base of participants as well. We survey all across the country, and we do survey as well. Our survey skews towards larger operators. We find that valuable. We find that the larger operators tend to lead the industry. So we're pretty confident in our sample size here as well. Getting into the actual results, the overall fear and greed index this quarter is at 58. So what does that mean? So our survey goes from a scale of 0 to 100. On the scale of 50 means as many investors are increasing their investments versus decreasing their investments in commercial real estate. That's a stagnant market. So 50 is right around that stagnant territory. Anything higher than that, you're seeing investment expand. Anything lower than that, you're seeing investment contract. And in our opinion, a healthy market is probably somewhere between the 70 to 90 range. Higher than that, you get towards the irrational exuberant side. Lower than that, the market's pretty stagnant over time. So we're a little bit below that healthy market side. We're above stagnant. And the market has improved recently in all these sectors here, but we're still a little bit below that healthy market side of things. Our index is a composite index, so that means it's driven by 3 primary sub-indices below this. We ask investors about their current investment strategy, what they did over the last quarter. We ask about their expected investment strategy over the next 2 quarters or the next 6 months. And then we also ask about access to capital. We always have a measure of velocity in our surveys. For CRE, the access to capital is really one of the rate limiting factors, so we care a lot about that. I think that index was especially interesting this quarter. This is how it's looked over time. We've been running the survey every quarter for about 2 years now. So right now we're at 58. That's the highest that we've seen in 2 years. So we are starting to see some thawing in the CRE industry. Still below that kind of healthy market, like I said, but definitely moving in the right direction. I mentioned that this is composed of 3 major indicators, so I want to walk through these here. The first one is, all right, what are commercial real estate investors doing today? When we break this out, we can see that about 64% of commercial real estate investors are neither increasing nor decreasing their exposure. So the market's, majority of investors are on hold right now, not changing their CRE exposure, not increasing their investments, but also not decreasing. This is, it's the majority, but this is also the lowest level that we've seen going back to fourth quarter of 2023, fourth quarter of 2023. So you can see that green bar down there at the bottom, 25% now expecting to increase their investments over the next, or now had been increasing their investments over the last quarter here. So that's positive. That's a good sign. We do see some thawing here, still mostly a frozen CRE market, but we are starting to see some positive signs here. I'm also encouraged by that red bar up there going down to 11%. The last time that there was more movement back in fourth quarter of 2023, that red bar was at 25%. So we're definitely seeing fewer investors decreasing their exposure, more increasing. The big change this quarter, I think, from our survey results came from this access to capital index. So we are starting to see access to capital improving substantially quarter over quarter. Still, you've got about 43% of investors saying that they're not seeing any change, about 18% saying that capital is getting harder to access. But really encouragingly, about 22% of investors saying the capital is getting easier to access. That's the highest that we've seen in the 2 years that we've been doing this survey. I think that comes from a series of rate cuts from the Fed, maybe a little bit more certainty relative to earlier this year. And we see this across sectors as well. We can break this out for multifamily, industrial, retail, and office over time. And now in every sector except multifamily, more investors say it's getting easier to access capital than it's getting harder. Except for multifamily where it's a little bit more 50-50 here. But things are definitely moving in the right direction across sectors here. Of course, again, the Fed cut rates in December, and the market expects SOFR yields to fall further in 2026. So you could see this continuing to ease over the next 6 months as well, which is, I think, came through in some of the commentary we got from investors as well. This isn't our data, but I think this taps into some of the same findings that we got from the survey. This data from the Federal Reserve. It's a survey of senior loan officers. They ask, are you increasing or decreasing standards for commercial real estate loans? And pretty universally right now, it's getting a little bit easier to get credit right now. Credit standards aren't quite loosening. It's still slightly above 0, but at least they aren't tightening anymore. And I would expect this to drop below 0 here. Below 0 means that a higher share of banks are loosening credit conditions than are tightening. Now, as I mentioned, for our survey work, we always put a lot of emphasis on expectations as well. So we always ask, what are investors expecting, especially this time of year for 2026? How are they planning for the next several quarters or for the next year? So we asked a series of questions along these lines. CRE investors generally did lower their near-term outlook. So even though we saw that increase driven in the overall index that was driven by that access to capital index, we have seen investors lowering their expectations, at least over the near term here. Very slight though, so only 39% say that they're going to increase their investments over the next 6 months, down just a little bit from 41% the prior quarter. Pretty flat in this over time. But still, the good news is more investors expect to increase their investments than decrease them across all the sectors that we track. You can break that down on a sector level as well and look how that's trended over time. You can see office for several quarters, more investors expect to increase their exposure than decrease over the next 6 months for office. Same thing in all the other sectors as well, but the direction of travel is a little bit different. Looking at multifamily there, you can see that this index peaked back in fourth quarter of 2024, and now it's been declining for about 4 quarters now. 3 quarters of decline, or 2 quarters of decline for industrial, retail a little bit more flat here. So why are they doing this? We always, at the end of the survey, we ask, we leave an open-ended comment box for investors to tell us anything that they think we should know about the market right now. Sometimes we get a pretty clear signal of what's going on across the market. I think interest rates was really the main driver here. But I think what was interesting this time is we got a pretty good range of headwinds listed. So interest rates, of course, oversupply, especially in the multifamily side of things, property insurance, utilities, property taxes, government regulations, all contributing to some headwinds that investors see coming down the pipeline for 2026. Tariffs and inflation, geopolitics, just general geopolitical risk here, and then rent control as well, one of the issues that came up repeatedly across our survey here. One of the things that we also ask about on the expectation side of things is expected change in asset values by asset class over the next 6 months. So things have been moving positive here for a while now, and I think they are still moving positive for the most part. Office now, investors expect positive asset value growth over the next 6 months. That's the first time that that's happened in our survey's history here. The change here was in multifamily, which has been kind of hovering around flat, just ticked a little bit lower to minus 1% asset values over the next 6 months. Direction of travel is moving a little bit lower here, but I think this quote really sums up things nicely. We got a quote from an investor that said value estimation is tricky because there just really haven't been enough sales to judge right now. I think that ties back to some of what we saw earlier with the frozen market. Again, 64 of investors neither increasing nor decreasing their investment exposure in CRE. Very few deals on the multifamily side have cleared the market yet, probably keeping average sale prices higher. So I think that's something to watch for going forward here is do we get more price discovery next year? I think the answer is probably yes. So the follow-up question that we asked here was, do you expect the number of distressed transactions to increase or decrease over the next 6 months here as we get into 2026? Overwhelmingly, 73% in multifamily expect more distress in 2026. Majority in office also expect more distress. Less in industrial and retail, but still in every single sector, more investors expect an increase in the number of distressed transactions versus a decrease here. Got another quote from an investor on the side here. In 2026, we can expect to see more transactions, but still at historically slow levels. We'll probably see more short sales. So I think that ties back into some of the expectations on price. Maybe we do get a little bit more price discovery next year as more distressed transactions come online. As a follow-up to that, we asked, all right, how is distress manifesting right now? We ask, in the last 6 months, have you considered or have you accepted preferred equity or rescue capital for any deal? 70 to 80% of investors in every sector said no, balance sheet is sufficient. Small share in every sector, between 2 and 11% down there, have actively or are actively pursuing rescue capital for their deals. But I think the most interesting part on this chart is that beige part right there, where you can see somewhere between 13 to 27% of investors in each sector are evaluating options. They're considering the idea of preferred equity or rescue capital for at least some deals. And I think this is a good leading indicator for potentially more distress next year. Investors are also broadly conservative on NOI growth assumptions. So we ask, what are you underwriting to? Less than a quarter or less investors are expecting more than 3% NOI growth in their models right now. For the most part, greater than 50% are expecting 2% or less NOI growth. So some conservative assumptions there. I think that ties back to kind of our thesis here, which is muted growth for most of CRE for 2026 here. Most investors are also underwriting flat exit cap rates. So we ask, how do you expect exit cap rates to compare to entry level cap rates? Right now, about half of investors, the plurality here, expect cap rates to stay the same. About a third, between 25% and a third, do expect some cap rate compression, maybe some upside there. But overwhelmingly, for the most part, investors either expect flat cap rates or expect some cap rate expansion in what they're underwriting right now. That's the high level results from our survey. I'm going to wrap up with some key takeaways here as we get towards the end, but I do want to pause for a little bit and let Chris do a deep dive on the multifamily space, which I think is super interesting right now. So I'll pass it over to you, Chris.
Awesome. Thanks, Alex. Thanks everybody for joining today. I'm excited to be here to, as Alex mentioned, really take a deep dive into multifamily. Certainly, it's one of the four main food groups within commercial real estate, and it's a sector that we've been tracking very closely. As Alex mentioned, more and more multifamily investors are expecting to see distress next year. If you looked at the graph that he showed about rescue capital and preferred equity, multifamily had one of the highest percentages of all of the four sectors in terms of those who are seeking or interested in needing rescue capital and preferred equity. So what's going on in multifamily? Fundamentals are still weak. Really, we've been in a period of weak fundamentals at the national level for about 2 to 3 years now. Good news is that they're stabling. Cross currents are emerging. So if you go back to the beginning of this year, last year, the story was supply, 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 and good demand following behind it. But we're starting to see more and more challenges on the demand side emerging. It looks like there we go. Just a little slow on the technical side, but seasonal patterns remain. So pre-COVID, before things went wild in 2021, 2022, this was typically the weakest part of the year, really October, November, December, January. We're back to that, where we've seen rents soften month over month for the better part of 2 or 3 months now. 25 was a little bit different. We saw an earlier slowdown than a lot of us were expecting. So rents cooled earlier in the year, but we're still seeing that normal seasonal pattern. And that's a good thing to return to kind of normal seasonality. I do think that most markets found a bottom in terms of occupancy. Occupancy stabilized. Now it's a little bit lower than the long-term average, but it's not falling anymore for most markets. There are some markets on the margin where we're still seeing occupancy challenges, especially in some of that new Class A stock. But for most markets across the country, occupancy is stabilized. Lease-ups are taking longer. As I mentioned, supply, supply, supply was the story. We are just leaving a generational boom in supply. We haven't seen this much supply since really the 1970s, 1980s. So lease-ups are taking longer. Beyond just the supply, we're now faced with economic uncertainty, as Alex mentioned, economic concerns, geopolitical concerns. That's really slowing down the pace of absorption and the pace of lease-up that a lot of folks were seeing even earlier this year. That being said, absorption is exceeding new starts, and that's good. We'll take a look at some data in just a second here. When absorption is above deliveries, when absorption is above new starts activities, that tells me that we're looking forward to stronger growth as we see more demand than new supply entering the market. Yes, there's still a lot of lease-up supply. We got to get through that, but there are sunnier skies ahead. I mentioned some of the cross currents, so I'm going to talk about the strengths and the weaknesses here. Again, economic uncertainty, recent weakness in the job market. Jerome Powell said in his press conference the other day that we may be even overstating the current job market. And so as we continue to see soft job markets, and this is much more of a metro by metro story. We haven't yet gotten the recent metro level jobs numbers, but when we do, I expect that would show some additional weakness where housing demand and specifically rental demand is getting squeezed. And finally, we do have a long-term demand tailwind for multifamily. For sale, affordability is very, very tight, very constrained. It is very expensive to purchase a home with today's mortgage rates and today's prices compared to rent an apartment, compared to rent a build to rent or even a single family rental home. Long term, that's a tailwind. Good demand driver there. We just have to work through some of these short term headwinds. So, as I mentioned at the top, a lot of cross currents. Supply is a headwind, economic uncertainty is a headwind, softening job growth is a headwind, absorption is a tailwind, long term demand is a tailwind. We just have to navigate some pretty choppy waters in the multifamily market right now. So looking nationwide, this is our current market conditions in the apartment market, multifamily market. Typically, anything you see from John Burns, when it's green, that means good. When it's red, that means bad. Orange and yellow, or kind of somewhere in between. But you don't see a whole lot of green dots here, right? Some decent strength in the Midwest, some strength in the Mid-Atlantic, and certainly some strength on the West Coast in San Francisco, San Jose, reaping the benefits of a lot of the AI boom that's driving the economy right now. But for the most part, it's a pretty soft rental market, pretty soft multifamily market. You see a lot of dark red in the Mountain West, Denver, Salt Lake, Phoenix, stretching through Texas. Austin has been the poster child for oversupply and weak rent growth. Now, we're coming at this, and a lot of the folks on this call are investors or developers. If you flip things around, it's a great time to be a consumer, a great time to be a renter right now in a lot of these markets. Concessions are high, rent growth is not astronomical, especially on the new lease side. Oftentimes, we're seeing rent cuts. We are seeing continued decent performance on the renewal rent side, so the overall industry is not in peril. But on the new lease side, it's somewhat tough. You see more red in places like Raleigh, orange and red in Florida. So overall, weak market conditions, as I talked about, that's current. But what we'll look at now is what we expect to see going forward. So I like to look at these absorption ratios a lot. This tells me what's going to happen down the road. So this is the absorption to start ratio. So this means right now, for every one unit started, we're absorbing about 1.6 or 1.7 units, which is good. We're absorbing more than we're starting. Again, that doesn't mean immediate rent growth. That doesn't mean immediate occupancy lift. But if you fast forward a year, 2 years, 3 years from now, that's good news if we continue to see this absorption. We're well above the long-term average in terms of the absorption to start ratio. Now I look at the absorption to delivery ratio, and this is much more of like a current day. So right now we're just under 1 in terms of absorbing every unit for every unit delivered. I do expect that to increase above 1 pretty soon. This data is through October, actually. I know it says July here. We can push this forward through October, but once we get the year-end data, I would expect the absorption to delivery ratio to even exceed 1. That means we're absorbing more units than we're delivering. Again, more of a real-time indication of what's going on in the market. And again, we're exceeding that long-term average. Breaking it down at the regional level, these are absorption rates. So looking at or I should say, these are absorption start and delivery rates. So first, this is the delivery rate showing the number of units delivered as a percentage of the total inventory. So still really high percentages of deliveries in places like Florida and the Southwest. There's been a lot of supply being added. We're still unwinding that supply story. But when you look at where we're absorbing, again, you look at Florida, you look at the Southwest, just ever so slightly below the delivery rate is where the absorption rate is. Once those tick over, I'd expect to see really strong gains in occupancy. The good news here is, again, we're not starting a lot of units. So again, not immediate performance, but I would expect performance to start to pick up in places like Florida, the Southwest, Texas. Look where we're at in Texas. The start rate is only at about 2%, delivery rate 4%, absorption rate about just under 4%. That tells me that Texas is on the road to recovery late next year into 2027 as well. And this is how it kind of plays out in terms of the overall number of vacant units. Again, you saw really an astronomical increase in total vacant apartment units nationwide. Now, you have seen a little bit of a slowdown in increasing vacancy. This is good news. Again, this slowdown in vacancy, put another way, is an increase in occupancy. And that's a good sign. As we continue to occupy more and more units, absorb more and more units, this is a good indicator that we'll get back to rent growth. With that being said, we really need to see this vacancy number, or vice versa, the occupancy number, increase back to a normal 95% occupancy. I'd like to see this total vacant apartment unit down in kind of the million to 1.05 million range. That to me is about a healthy market, healthy multifamily market, and we'll likely get there kind of mid to late next year. Again, market by market, could take a little bit later, could be a little bit sooner, in markets like California and the Midwest. And finally, how does this impact overall rent growth? That's the metric that a lot of folks really are focused on. After the run up in 2021, 2022, we've really been in a stalled out market. Now, SFR, that's scattered site single family rentals, are a little bit stronger than BTR in the multifamily market. But you see the blue and purple lines. Purple is apartment, blue is BTR, the purpose built build to rent communities. Rent growth year over year is just about flat. We're expecting another flat year next year as well. Maybe a little bit of growth market by market. You could see some markets stay negative. Some markets have stronger rent growth, but not a really robust market next year. 2026, we expect to be a stabilizing year. 2027, we should see stronger growth. 2028 as well, as supply really slows down. So I'll turn it back over to Alex in just a second. He did mention at the beginning, we do have a number of surveys across all housing sectors. Two that I want to point out specifically for the folks that might be interested on this call. We do have a quarterly apartment developer and investor survey, as well as a quarterly build to rent developer, operator, and investor survey. As Alex mentioned, these are really kind of the tip of the spear, the leading indicators when we get these sentiment surveys coming in. This tells us where the market is going. The data that we reference often is slightly lagging, but these surveys are really the forward-leading indicators that we rely on most. So if you're interested in joining our developer survey, developer and investor surveys, please reach out to me, reach out to Alex. We'd love to have your participation and would love to share the data back with you. So with that, I will turn it back over to Alex to bring us home.
Muted. All right. Thank you, Chris. Yeah, like I said, I'm going to wrap up with a couple key takeaways here. I think the broad theme through what Chris was talking about on the multifamily side, as well as what's coming through in our survey for the other sectors that we track as well, is that we've got a pretty muted 2026 outlook. Of course, we cover housing as well. Same kind of deal for housing. We're expecting pretty muted growth for a lot of the industry here. CRE investors, at least in our survey here, are broadly optimistic on 2026. But any growth that we see next year is likely to be modest. We've got some pretty conservative underwriting assumptions that's come through in our survey. We've got a lot of headwinds that our investors are talking about right now. And I think that's going to weigh on at least the first half of 2026 here. We're breaking it down to the sector level. As Chris mentioned, on the multifamily side, there's significant but declining new supply. That's going to keep rent growth muted in 2026. The good news is we are starting to work through some of that. We're on the other side of the hump on completions and deliveries. Still a lot of lease-up supply out there, but that's being worked through as time goes on here. On the industrial and retail front, these are right now the most resilient sectors, I think, in our survey. I have the strongest expected asset value growth. We're seeing improving investor sentiment now that some of I think the tariff or just general policy related concerns have started to fade just a little bit. Investor sentiment is still positive here. And then office as well is on the upswing, where, as I mentioned, we asked about distressed transaction. I do think that we're going to see some more distressed transactions in 2026, maybe some more price discovery. But I think along with that comes opportunities as well. So we look forward to opportunities. Of course, we're seeing capital getting slightly easier to access. That's going to make for hopefully some slightly easier deal math in 2026. We're seeing short-term rates come down. In our forecasts, or what the market's forecasting for long-term rates, also a tiny bit of relief in the forecast right now for that as well. So hopefully that manifests in 2026. There's medium-term opportunity, especially for rentals right now once that supply glut clears. Not a lot of inventory being started right now. So I think there's potential for rent growth kind of in the outer years, years 3 and 4 here. And then, of course, distressed opportunities coming to market very likely in 2026. We have this survey. We call it our fear and greed survey. I think it's always it's always worth noting the great quote, be greedy when others are fearful here. I think there are going to be some opportunities coming down the pipeline in 2026 for no matter which sector that you're in. So with that, just a few final housekeeping items. If you want to access the survey results, they are available both on the CRE Daily website as well as our website. You can use either of these links here. If you want to get future surveys sent directly to your inbox without having to go to the website and downloading them, you can sign up for CRE Daily's newsletter. You also get CRE news and insights every single day. It's a great way to keep on top of the market. We also have a newsletter on the JBREC side. We focus a little bit more on the residential space, but we do have some CRE analysis. Somewhere between 1 to 3 times a week, we'll send out a newsletter there. And then if you want to participate, as Chris mentioned, I'm sure that some of you guys participated in this survey as well. If you want to participate, definitely sign up for CRE Daily's newsletter. You will get a personalized survey link that way each quarter, and you also get a chance to win a prize. We do have a couple of gift cards up for grabs for participating in that survey, and we'd love to have your response. It'll make the survey all that much stronger. With that, that's all I got. Please reach out to us if you got any questions. Otherwise, happy holidays. We'll see you next quarter.